Hello friends, welcome to the Banker Zone. Introduction to the Treasury Management. Now see, concept of Treasury. So basically, Treasury Management is a business process that focuses on the maximum utilization of the fund consistent with the overall strategic objective of the bank. So what is the Treasury Management? Simply, we have to use the maximum fund. So maximum utilization of the fund. So whatever the funds we are having, we have to do the maximum utilization of the fund to earn the profit. So simply, Treasury is also responsible for managing the different reserve requirement of RBI. It can be CRR or the SLR. That means the cash reserve ratio or the statutory liquidity ratio. All management of it simply the function of Treasury. Previously, the Treasury was only the back office function. However, they were only providing the service roles. Now, currently, Treasury is evolved as the profit center, right, with own trading and the investment activity. So remember, previously, Treasury is viewed as only as the back office function providing services to the clients. However, nowadays we can see the Treasury is earning lot of profit. So we can say Treasury is evolved as the profit center. So Treasury can do its own trading activity and investment activity through which the Treasury is earning the profit. Treasury is also involved into the asset liability management. So asset liability management is one of the important function of the Treasury. Concept of integrated treasury refer to the integration of money market, the security market and the foreign exchange operation. So what do you mean by integrated treasury? Just understand, integrated means what? You have done the integration of different department at one place, right? So first is the money market, second is the security market and third is the forex operation. So what is a money market means? One bank can borrow or lend to the another bank. For example, HDFC Bank needs money, they can take it from State Bank of India, right? So what is security market? Simply buying and selling of a security. That is what simply the shares. You purchase the share of say the Tata Motors. So that purchase and sale of a share, that is what simply the security market. Forex market means simply the foreign exchange, buying and selling of the foreign currency. So if you do the integration of all three businesses, that is the money market, security market and the foreign exchange operation, that is simply called it as integrated treasury, right? Okay, now what are the driving forces of an integrated treasury? So the integrated cash flow management, the interest arbitrage, then access to the global resources, corporate demand for the high-end services and the risk management. So these are the reason basically why we need the integrated treasury, right? So if we have to manage the cash at a global level, right, then the what is interest arbitrage means? Buying at a lower interest and lending at a high interest. That is what simply the interest arbitrage. Then the access to the global resources, corporate demand for the high-end services and the risk management. So obviously big clients are there, they need the high-end service, right? So these are the reason basically why we need the integrated treasury. Okay, now what are the important functions of the integrated treasury? Let's understand one by one. Obviously, treasury do the reserve management, that is what? Meeting the reserve requirement, that is what? The CRR, SLR. So this is important function of a treasury. Then global cash management, it refer to the physical cash even with the sending and receiving the money. So if the foreign branch of SBI needs money, so it can be done using the integrated treasury only. So global cash management. Then efficient merchant services including the forex and the advisory services. So what do you mean by merchant services? So merchant services include like a bank is providing the payment gateway, online payment gateway to its client. Bank are providing the different POS machines, right? So these are what? Simply the merchant services. What are the forex services? Simply exchange of foreign currency. Then advisory services. So merchant, what are the advisory services banks are providing? So banks also provides the advisory services. For example, if any company want to raise the fund using the IPO, so they need the merchant banking and which can provide the advisory services and the banking services. So bank can do different work in the IPO. If any company want to raise fund in the capital market, they need one bank as a merchant bank, right? So these are the services provided by the bank. It can be the merchant services, it can be the forex or the advisory. So that work has been basically done by the treasury department. Then optimizing the profit by exploiting the market opportunity in forex, money market and the security market. So obviously, how to integrate treasury will earn the profit? Simply they will invest and they will earn more, right? Simply investment into the different market, right? It can be the money market, security market or the forex market. Treasury earns the profit. Then risk management, very important. That is what? Managing the market risk. What is market risk? Fluctuation into the prices is referred to the market risk. So risk management is one of the important objective of an integrated treasury. Then assessing into the asset liability management. What is asset liability? So whatever the loans bank have given, these are the asset for the bank, and whatever the deposits we are having, it is a liability for the bank. So managing that is also one of the important function of the treasury. Then fund transfer pricing. What is the transfer pricing mechanism? Understand the transfer pricing mechanism. For example, say there are two different branches, B1 and the B2. There are two different branches. So bank B1 is having suppose deposits and loans, right? And bank 2 is also having suppose deposits and the loan. So deposits with the branch B1, say the 60 crores, and loans they have given 50 crores. However, just vice versa with the branch 2, they are having deposits say 50 crores and they are given the loan 60 crores. So then you can manage how there is mismatch between asset and liability of both the branches, right? So head office come into picture, head office. So whatever they are having excess deposit 10 crore, automatically that will go to the head office, right? So 10 crore will go to the head office. Branch B2 needs a 10 crore more because they have lent 10 crore more. So they can take it from the head office. So lending to the head office indirectly, it is also called as lending to the head office. So that branch B1 get more interest from the head office, and branch B2 has borrowed from the head office. So branch B2 has to pay some more interest to the head office. So because every branch we have to calculate the profit for every branch, right? So this is simply concept of transfer pricing. So it is nothing but the head office interest received, head office interest paid, right? There is, you can just check out in your sundry account, there may be some transaction like that. So that is basically the transfer pricing mechanism. So head office can borrow from the branches. And so this is automatically happening in CBS. No need to worry. You have to do nothing, right? So at the back end it is happening. So to match that transfer, to match that price, for example, if any branch is having the excess deposit, they have given loan of say 50 crores and they are having deposit of say 60 crores. So 10 crores can be directly given to the treasury department. So treasury department will take additional 10 crore, and that can be invested into the say different market, money market or security market to earn more profit. So it is simply the transfer pricing mechanism. Okay. Now next is the roles of treasury. So basically treasury do the three different roles, right? One is the liquidity management, second is the proprietary position, and third is the risk management. So these are the three different roles done by the treasury. So what is the liquidity management? Very simple. Treasury is responsible for managing the short, medium and the long term fund across the currency and complying with the different reserve requirement of RBI, say SLR, CR, right? So that is simply the liquidity management. So if bank need the funds in short term, medium term and long term, how that should be managed? That is part of treasury, and obviously managing the CRR, SLR. What is the proprietary position? So treasury may trade in currency, security or in derivative or even other financial instrument to have the proprietary position. What is the proprietary position? Simply see, the term proprietary refer to the activity or the trade which is carried on behalf of the bank itself and not for the customer. See, treasury do two things. For a customer, they can do the inward outward remittance in the foreign currency, right? Apart from that, they can invest whatever the money they are receiving from the head office, they can invest it and they can earn the profit, right? So you are earning the profit for the bank itself and not for the customer. It is called the proprietary position. What is proprietor? Proprietor means you are the owner of the business, like that. You are working in treasury department, so you will get some money, right? For example, you are getting 5 lakh rupees. So you have to invest and earn the profit. The profit will go to the bank, not to the customer. That is what the proprietary position. Earning profit for the bank itself, working for the bank itself to earn the profit. That is what the proprietary position, right? Okay. Now next is the risk management. What is risk management? So treasury help in bridging the gap of asset liability. Also that it provide a derivative tools to manage the risk and manage the risk inherent in its proprietary position. So simply one way, one line, risk management is also the work of treasury department, right? So the treasury can use the different derivative to manage the risk. Apart from that, if you take the proprietary position, that means if you have invested, obviously by default, inherent means by default there is a risk involved. That is what inherent risk. To manage that inherent risk, treasury do the work. Okay. So simply, what are the roles of treasury? To manage the liquidity, to have the proprietary position so that we can earn the profit, and risk management. So these are the important role of a treasury. Okay. Now treasury how to manage different books. First is the ALM book. ALM is simply, what is ALM? It is internal risk management. The book maintained for the risk management is called ALM book. ALM means asset liability management book. Every treasury have to maintain. Apart from that, there is one merchant book and one trading book. Merchant book is for customer related transaction. That is what it can be currency or derivative. However, trading book is for bank's own transaction. That means how means to manage its proprietary position. Proprietary means what? Working for a bank to earn for the bank. It is the proprietary position. So when you take the proprietary position, you invest, you earn, you give profit to the bank. So that all transaction is recorded into the trading book. It is very, very important. Merchant book means simply for customer transaction, and trading book means for bank's own transaction. Okay, and ALM book is for asset liability management, internal risk management book. Okay, so that the three book we are managing as a treasury. Now see, organization structure of a treasury. Treasury can be the department or it can be the separate bank. Nowadays very common. Treasury is separate department almost in every bank. Okay, so you can forget it can be the separate bank. Nowadays treasury is a separate department. The small bank can make a treasury as a separate branch. However, treasury is generally the separate department. Treasury is normally headed by the senior management executive of the bank, or you can say you should be at a general manager GM level equivalent to the PSB. Okay, so head of the treasury generally equivalent to the general manager. Nowadays general manager means you can take the rank like a zonal manager. So the chief of a treasury report directly to the CFO or CEO of the bank, right? So who is the head of treasury will directly report to the CEO of the bank. So treasury is segregated into the three main divisions. So what are the three departments basically we are having in treasury? So in treasury we are having the front office, back office and the mid office. Very simple. Front office, it is also called as the dealing room, right? So one by one we will discuss in detail. Front office. So basically see, one thing you remember here itself. Treasury is having three departments. One is the front office, another is the mid office, and lastly we are having the back office. Front office is also called as the dealing room because all the deals are happening in front office only. Okay, now see one by one. What is the front office? What is the dealing room? See, you can check out just image here. You can refer it for your understanding purpose. So dealing room from where all the transactions are put through is the front office of the treasury. So from where all the transactions are happening, simply through dealing room all the transactions are happening. So it is headed by the chief dealer. So every dealing room will have one chief dealer who will host of all, that means simply who will be the boss of all dealer working under him. The security market are divided into the primary and secondary market. What is primary market? See, in a treasury we can deal into two markets, primary and secondary. See, primary means very simple. Primary means first time the securities or the instruments are being sold or paid. Secondary means further after purchasing it can be traded into the secondary market. Very simple, right? So dealer can buy or sell the instrument or the product in the secondary market only. However, dealer may participate into the auction of T-bill and the government security. Understand the meaning of here. See, primary security means simply the market. Primary market deal with the issuance of fresh security. For example, the stock, the bond, the financial instrument, right? Or raising the capital. So you tell me, raising the fund or IPO is example of which market? Primary or secondary? IPO is the example for the primary market. First time securities are being sold, first time stocks are being sold, it is called the primary market. So once you sold the stock, you can purchase and sell in the another market called the secondary market. So mainly the dealer can buy and sell into the secondary market. Why not in primary market? Because a primary market is a big deal where it is nothing but the investment. So primary market means like investment. So in which company to invest or not, it is not decision of the forex, it is not a decision of the say dealing room. It is a decision of the management at a high level or the board of director. They will decide in which company we should purchase the share, in which company we should invest so that we will get a return. So it is not part of the treasury. So dealing in a primary market is not generally the part of treasury. It is done at the head office or it is done at the board of director level. It is high level management. Okay. Now the front office is also called as the actual profit center. Why? Because they are doing the deals, they are earning for the bank. So we can say they are working as an actual profit center. So what is actual profit center? Treasury is evolved as the profit center, and within that treasury we can say front office is the actual profit center. Okay. Now see the back office. So obviously name it is indicating back office. So treasury administration is the function of back office. So back office is responsible for verification and the settlement of the deal, confirmation of the from the counterparty, then accounting with respect to the deal, and submission of a periodic return to the RBI. So these are the function done by the back office. What are that? Simply verification, settlement, confirmation, and accounting. Apart from that, the periodical report return to be submitted to RBI. So all that work has been done by the back office. Simply in one line, if I had to say, I will say the back office is responsible for the administration. Apart from that, back office have to maintain the following accounts. What are that? The nostro account means simply, it is simply the foreign correspondent bank account. Means what? Simply, for example, say the HDFC from India is having account with Citibank in the USA in dollar. So that is what our account with you. It is called as the nostro account. Then account with the RBI they have to maintain for a funding and security purpose, and they have to maintain one demat account also for the depository, and that should be with the depository participant. It can be the CCI like that. Okay. So remember, back office have to maintain different account. One is the nostro account, another is account with the RBI, and third is the demat account. Now see, the bank office ensures that there must be the allocated margin money that should be kept with the CCIL, that is for rupee dollar settlement. It is very, very important. So back office has to ensure that there must be the margin money kept with the CCIL. What is CCIL? CCIL stands for the credit. CCIL is simply Clearing Corporation of India Limited. So with the Clearing Corporation of India Limited, the back office have to maintain some money that is mainly for the dollar to rupee settlement. Dollar to rupee settlement. CCIL maintain the settlement guarantee fund also. Remember, CCIL is also maintaining the CCIL guarantee fund, also called as the CCIL is maintaining settlement guarantee fund, SGF, settlement guarantee fund, by collecting the margin money from different constituents in order to avoid the payment failure. Okay, so they means simply they will have separate reserve for the to avoid the payment failure by the bank. Okay, now see, next is the mid office. Mid office is 100% dedicated for the risk management. So mid office is having two main functions. One is the risk management, and second is what? Providing the MIS. That is what? Simply the management information system. That is MIS. Means simply the report they have to send to the management, right? So you only when you remember, at least when you remember, right? So mid office is 100% dedicated to the risk management. So in the risk management itself, they are preparing the MIS, sending all the report to the management. Okay. So monitoring the exposure limit, stop loss limit, they are done by the mid office. The report on the performance of the front office is also sent to the management by the mid office using the MIS. Then small bank, in small bank, mid office also undertake the ALM and the transfer pricing mechanism. Mid office should comprise of the expert in the market, risk management, economist, and the statistician and the banker. So who can work under the mid office? Simply the different expert from the market, different expert into the market risk management, the different economist, and the different statistician and the banker should work into the mid office. Why? Because we have to manage the risk. So it is very, very important to manage the risk, right? So mid office should be separated and should not involve in day-to-day activity of a management of treasury. So why? Because the risk management of risk is very, very important. That's why it should be separated. The mid office report directly to the chief risk officer, and obviously CRO, chief risk officer, will directly report to the RMCB means what? The risk management committee of the board. Very, very important, right? So remember here, the mid office report to the chief risk officer, and he report to the risk management committee of the board. Front office, mid office, and the back office directly report to the different vertical head. Why different? Because there is not one common head. Why? Because there must be the segregation of the duty and control at all level. That's why front office, mid office, and back office, they are reporting to different vertical head. So they are having different heads. Okay. So what is, in one line, you tell me, what is function of mid office? The risk management is the function of the mid office. Okay. Apart from that, we are having one department called the investment department. So see, the dealer into the front office dealing room, they are investment only doing into the secondary market, into the secondary market, and not a primary market. So who can do the investment into the primary market? So the investment department can do the investment to the primary market. So this department mainly deal with the dealing in primary market. So investment committee is constituted to go into the merits of the proposal and make a recommendation about the investment. Okay, so very simple. Investment department, if there is a present in treasury, they can do the recommendation to the higher management to invest into the primary market. Okay, now there can be the other department, for example, like account department, the administration department, the system administration, or remittances like RDGS and FT department can be there. Apart from that, there are mostly administrative and the supportive in nature. So these are not having in picture proper. Okay, so they are just for your support only. support of treasury. Some banks can have the cash management department also under the treasury for interbank cash transfer. Okay, so this is not important that much. Okay, only you remember there are only three main departments in the treasury: the front office, the mid office, and the back office. Front office is responsible called as a dealing room. They are directly participating into the deal. Mid office is responsible for the risk management, and the back office is doing the administration function like confirmation and settlement of the deals. Okay, now so you can check out just here the treasury structure. No need to go through it. Okay, it is just for your information. Okay, now how we can say that treasury is the profit center? How we can say treasury is evolved as a profit center? So treasury profits have become more focused for most of the bank due to the following reason. So why treasury have become a focus for more bank? Because treasury operate largely into the interbank, which is relatively free from the credit risk. So what is interbank means? What one bank is giving money to other bank. So for example, HDFC Bank is lending to the State Bank of India. So whether there is a risk involved, so almost zero risk is involved, because obviously one bank is lending to other bank, so no capital requirement we have to make, right? So it is almost free from the credit risk. So obviously the SBI will obviously return to the HDFC Bank. They will not go into default, right? So that's why we can see that the treasury which operate into the interbank deal, it is free from the credit risk, so we can get more profit. Treasury activity is highly leveraged, and hence return on the capital is also high. What do you mean by highly leveraged? So highly leveraged refer to what? For example, you have taken the loan for at 5% and you are lending it at say 8%. So 3% you are earning here, right? So in the same way, treasury department is what doing? They are taking the deposit from the bank at 5%. They are lending at say 8%, or earning, they are by investment they are earning 20%. So more they are earning with borrowing at a lower percent, and the same earning by investing more percent means what? Borrowing at a low cost and making investment earning at a high cost, at a high price, sorry, right? So what is the highly leveraged means? What? Borrowing is done at a lower percent, say 2%, 5%, and the same fund is invested to earn more profit, say 20%. So it is called the highly leveraged. Okay, so return on the capital is very low. The return on a capital is very high. So see, in treasury we are doing the investment, right? We are doing the interbank transaction. So here the requirement of a capital is very less, because risk involved is very less. So we can say whatever return we are getting is high in the treasury. Okay, so whatever return on the capital is high in the treasury activity. So treasury activity is highly leveraged and return on the capital is also high. The operational cost is low compared to the other banking activity. For example, in branches we require more staff, right? Whereas in treasury we require less staff. So few specialist staff is only required. That's why we can say the cost is also less. So due to that reason, we can say treasury is evolved as the profit center. Okay, now how treasury basically earning the money? So traditionally using the forex business, using the money market deal, and in the investment. So that three way traditionally the treasury was earning the money. However, nowadays conventionally means nowadays currently using the arbitrage, the trading into the security, foreign currency, equity or derivative, and sale of a treasury product to the clients. So and that way also treasury is earning the money. Okay, so previously only by the forex, money market and the investment, treasury is earning the money. However, nowadays using the arbitrage, trading and the treasury products, the treasury department is earning the money. Okay, one by one we have to see. So see, traditionally how traditionally the treasury department is earning the money. Okay, so see, first is the foreign exchange business, second is the money market, and third is the investment. So foreign exchange means simply buying and selling of the foreign currency. So whatever difference we are getting in buying and selling, that is called as the spread. Buy it at a 5% and sell at a say 6%. What is spread? 1%, right? Buy it at a 50 rupees, sold at a 60 rupees. What is difference? Tail. So 10 rupees what? The spread. So difference between buying and selling is simply referred as the spread. So buying and selling of foreign currency, that is foreign exchange business, through which treasury is earning the profit. Then money market deal. Money market means what? Lending money, whatever extra we are having, lending that surplus fund whenever, and borrowing when it is needed. That is called the money market transaction. Now transfer pricing mechanism means simply determine the fund cost of the branches. So that is also done by the money market deal. So what is the money market deal? One bank needs money other banks takes it from the other bank. For example, HDFC give money to the State Bank of India. So giving money to the State Bank of India will definitely the bank will earn the 7% say rate of interest. So 7% earning lending from HDFC to the SBI, it is the money market deal. Then next is the investment activity. So bank invest into the government security mainly to meet the SLR or CRR requirement. And also bank will invest into the non-government security also to earn the more profit. That is simply the investment activity. So whenever we invest into SLR, bank is obviously getting some returns, right? So this is the investment activity. So obviously, if a bank is investing into the non-government security, that must be purely to earn the profit, right? So this is simply the traditional activities. Now see, the contemporary banking activity means these are the now currently banks are following to earn more profit from the banks. Okay. First is the interest arbitrage. What is arbitrage? Arbitrage means simply buying at a one place and selling it at other place. It is called the arbitrage. Right. For example, you purchase the potato from Kochi at say 50 rupees per kg and you are selling it in Ernakulam at 60 rupees per kg. So you are doing the arbitrage. That is what arbitrage. So using interest rate differential across the currency and the market, borrow in USD and lend in rupee. So that is what interbank market or vice versa. For example, in USA you borrowed at a 6% and you lend in India at a say 15%. Why? Because in USA currency is available at a cheaper rate. So this is done. That is called the interest rate arbitrage. Right? What is interest rate arbitrage? Simple thing you do. You understand. The bank is taking deposit from the customer at 6% and lending to the customer at 12%, right? So this is what the bank is doing in the interest arbitrage, right? Bank is doing the interest arbitrage. So bank may borrow into the money market for to invest into the short term, that is a commercial paper or the T-bills, or bank can lend to the other bank like cooperative bank or small banks at a higher rate of interest. So how interest arbitrage work? In the money market, bank is taking money, right? Bank can take money and will lend it money in the form of say the commercial paper or the T-bill. So if bank has borrowed money from the money market, for example, the HDFC bank has borrowed from the State Bank of India at 5%, right? So the same money bank can invest into the short-term commercial papers or also say treasury bills, or sometime they can also lend that money to the other bank to earn more profit, right? Treasury bill utilizes various money market instruments. What are the different money market instruments? The commercial paper, CD, certificate of deposit, then treasury bill, then TREPS. TREPS means tri-repo dealing system. Tri-party. TREPS means tri-party repo dealing system. Tri-party repo. That is TREPS. So these are the different money market products, money market instruments. Okay. Now trading. How trading is giving profit to the treasury? Obviously, trading is involved yielding the profit using the buying and selling. So short selling prohibited in a banks in India. So see, what are the treasury function? It includes the long and short. So what is the short selling? Short selling means simply you don't have that currency, still you are able to sell it. How? For example, you are having account with say Zerodha. So Zerodha temporarily will give some stocks. You can sell it without actually purchasing. That means it is like they have given you for some time, or that means you can sell it without having it. But at the end of the day, you have to make it zero. You have to make it the nil position. If you have sold it, at the end of the day, you have to buy it and give it back to the Zerodha or whatever you are having as a demat account, right? So very simple. So no need to worry about the short and long, because in the future lectures, in the forthcoming units, we have to discuss all in detail, right? So long means simply the buying position, short means selling the position. So short selling means what? You don't have the currency, you don't have the stocks, still you are able to sell it. Okay. The trading credit instrument in the form of PTC. What is PTC? PTC stands for pass through certificate, which are simply issued by the special purpose vehicle SPV for the purpose in the securitization. Okay. So securitization means simply when the loan become NPA, right? The bank will sell that loan, for example, to the company, that is SPV, and that is SPV. After purchase, the other company will purchase that NPA loan, and they will issue the pass through certificates. Bank are allowed to engage into the derivative product. Currently, the currency trading, that is what the bank with AD1 category license will only able to trade within the currency trading, and they obviously they will have some limits. Okay, only category AD1 license bank can trade into the foreign currency. Okay, now treasury products. So the treasury is also having different treasury products. Okay, Treasury is having different products. So in the next unit, we have to discuss in detail what products Treasury is having. Okay. Treasury offer foreign exchange, derivative and structured product to its corporate client. For example, it can be the certificate of deposit, commercial paper, the treasury bill, the repo, forward, swap, option, future, etc. Corporate seeks new product to hedge against the currency or the interest rate risk. So why corporate need that product? Simply to hedge against the risk. So that means they will purchase the swap. Means what? To avoid the future risk. That we are discussing in detail in the next unit. No need to worry. Swaps can convert the floating rate loan into the fixed rate. Swap means you are swapping basically two different rates, floating versus fixed or fixed versus floating. Treasury products include the built-in profit margin. So obviously, whenever we are dealing with treasury, obviously in every product we are having some margin. It is also called as the buy-sell spread. Okay. Now the process of globalization. So what is globalization? Simply connecting the Indian market with the foreign market. So the process of integrating the domestic market with the global market. So in that we have to allow the free capital flow and a minimum regulatory requirement. That is all simply the globalization. So capital flow for a trade remittance and the investment, and it is regulated by the central bank, see RBI. So every country have the central bank, they will regulate the whatever the capital flow in and outside the country. Capital flow, what is capital? Capital means the big money simply for the purpose of investment. That is called capital. Capital flow manifests in multiple dimensions. So why basically capital flow? For the purpose of portfolio investment, for the purpose of direct investment by the foreign company, the ECB, external commercial borrowing. What is ECB? Means simply the Indian company is taking loan from non-Indian company, right? Indian company is taking loan from USA company. That is called simply external commercial borrowing. Insurance of the equity or the debt in the global market means issuance of the equity or debt. Means any company want to go globally, they can have ADR or ZDR. Means what? American depository receipt or a global depository receipt. The merger and acquisition between the domestic and the foreign company, then payment for technology transfer, royalty or the financial services. So these all are nothing but the resulted into the capital flow. All transaction which involve interest, fee, dividend or the capital repatriation. Repatriation means simply sending it back to the original country in a foreign currency, often categorized as the transfer of saving. What is transfer of saving? You have invested, you went to the USA and you are earning there in dollar. You are sending money back to your parent in the India. That is what? The transfer of saving, right? Okay. Now the process of globalization. See, the East Indian crisis happened in 1990. That is due to the capital withdrawal. That is massive capital withdrawal happened in the 1990 in East Asian crisis. India is also one of the part of it. That's why we went for the LPG reform. Okay. FEMA in 2000, FEMA of 2000, there is modified version of FEMA, which is replaced with the FERA, Foreign Exchange Regulation Act, FERA Act. So FEMA is Foreign Exchange Management Act, which facilitate reform into the that is what? Liberalization of the foreign currency transaction. So that we have to discuss in detail in second unit, right? So RBI has increased the capital flow through the automatic route. What is automatic route? So inflow outflow of the currency can happen in two routes. Automatic route means what? There is no need to take the permission from the RBI. It's called automatic route. Okay. So FEMA means Foreign Exchange Management Act, which have given some liberalization into the foreign currency transaction. Okay. RBI has allowed bank can borrow into the foreign currency through the overseas correspondent capped at 100% of their own capital or up to USD 10 million, whichever is higher. Okay. So this can be your exam point of view. Question is important. Bank can borrow the foreign currency up to 100% of the tier 1 capital or maximum $10 million US. Okay, so just to check out whatever we have learned here. So basically, integrated treasury means what? We are having three departments: money market, security market, and the foreign exchange operation. What is integrated treasury function? Simply manage SLR, CRR, global cash management, merchant services, forex and the advisory services, risk management, ALM, and transfer pricing. What treasury do the role? Liquidity management, risk management, and the proprietary position. Why we need basically so basically treasury need to manage three books: ALM books, merchant book, and the trading book. Merchant book for customer, trading book for its own bank transaction. Treasury is having three basic divisions, three department. We can see front office, back office, and the mid office. Mid office is doing risk management, back office is doing the administration work, and the front office is doing the dealing room operation. How treasury earn the money? Traditionally, forex business, money market, and doing the investment. However, nowadays, by the arbitrage, trading, and the treasury selling the treasury product, treasury is also earning the money. Okay, so this is just one part summary. So you can download the Android application. We are having Banker Zone CIB. This is the name of application. You can just go to the Play Store and search Banker Zone CIB. You will get the application where you will get the full courses. Thank you, friends.